Okay, everybody, we'll give it just another 30 seconds or so for everybody to get in, and then we will get started. Okay, welcome to the July 12th edition of the Fats, Fuels, and Oils webinar. I was off last week, obviously, and so I've been catching up, and as a result, the commentary hasn't been published yet, but I have updated the data in the forecast, which just kind of looking through it kind of quickly looks like was a little bit of mixed success, but hopefully we'll have some stuff. Well, we'll definitely have some stuff to look at, but there's been a lot going on, so I'll get right to it. And what we will start with is today's USDA report and the changes that they made to the soybean oil balance sheet, or the U.S. soybean oil balance sheet is the one that I've kind of had a chance to take a little bit of a look at. This month's report included the acreage data that USDA released at the end of June, and so that that reduced production, given that beginning stocks for 22-23 were already relatively tight. That meant that USDA was going to need to cut its demand forecasts. And if you'll excuse me for just a second while I try and find a file. And so what they did is they cut exports by 65 million bushels, and then they reduced crush by 10 million bushels. And as you can see, that reduced soybean oil production by 120 million pounds. They offset that with 100 million pound, or mostly offset that with 100 million pound decrease in their non-biofuel domestic use, which takes it down to 13.7 billion pounds, still well above our 13.7. Again, we have this disagreement between what we think soybean oil demand for biofuel production will be relative to what USDA thinks, both in 22-23 and in 21-22. For 21-22, they also reduced crush a little bit, and that cut production by 100 million pounds. They cut imports, and as a result, they needed to cut, again, non-biofuel use, and they also cut exports down. We think they could probably cut exports a little bit more based on the data that we got from the Census Bureau last week. It looks like exports are kind of on the same track that we saw last year, where June will probably be the last month that we have significant, in air quotes, exports. They'll probably be around 90 million pounds, and then we'd probably go to something around 30 million pounds a month, or a little below that in the last quarter of the marketing year. And that gets us, I think, closer to our 1.7 billion pound forecast than USDA. So I would expect that they'll have to continue to reduce their export forecast in the coming months for old crop. All of that doesn't really explain what has been going on with soybean oil prices and commodity prices more broadly, and then also in the fat and grease markets. And I want to talk a little bit about our price forecasts and sort of the difficulty in trying to predict prices in the current environment. So obviously, commodity prices very broadly have come off really substantially from the highs that we saw earlier this year, because there are concerns about an upcoming recession. And so as a result of that, I think you've seen a lot of speculative liquidation that has pushed prices down, in some cases probably below where the fundamentals would suggest that they would be. So for example, the fundamentals for soybean oil, or soybeans for that matter, have not changed that much, but the prices have really dropped pretty dramatically. And the last time we really went through something like this was in 2008. Obviously, the recession in 2008, or maybe hopefully the recession in 2008, was much more severe than the recession that we're potentially going to enter into right now. But you saw basically the same thing in commodities. You had a big run up in commodity prices in 2000, really starting in sort of 2005, but accelerating in 2006, 2007. And then prices peaked in June of 2008. And then you saw prices drop, not as quickly as you've seen this time, but very steadily through the summer of 2008, despite the fact that the fundamentals for the markets didn't really change that much. And I think we're going through kind of an accelerated version of that, where commodity prices in general are going to come down. I think given the differences in the fundamentals between now and 2008, and the fact that the recession is not likely to be as severe as it was in 2008. It's basically the Fed is raising interest rates, and so that's slowing the economy down. Whereas in 2008, obviously we had the housing crisis, and there are differing opinions on exactly what's going to happen in the economy. But I think that if the Fed were to stop its interest rate increases tomorrow, you would probably see a pretty substantial rebound in commodity prices back towards something that's maybe closer to the fundamental value. And I think without a doubt, probably 3 months ago, we were well above that fundamental value. Now I think we've probably come down below that fundamental value. That in and of itself makes it difficult to kind of say where we think prices will go, because if you're not anchored to fundamental value in some way, you're just kind of guessing at how low prices can go or how high prices can go. It's kind of similar to trying to predict where prices are going to go, or how high prices are going to go when you're already at record levels, and that level is above what the fundamentals would suggest. It's sort of the opposite side of that same problem. In addition to that, the thing that makes predicting soybean oil prices difficult. And so you've seen our forecasts move around a little bit more than I generally like to move our forecasts around. But I think that I'm comfortable with where we are now, and barring a continued collapse in commodity prices, which with soybean oil down 3 cents a day is obviously not out of the question. Hopefully you're not going to see huge changes in our price forecast in going forward in the coming weeks. I think I cut prices by like 10 cents or something over the last couple of weeks, which is just not something that I've done in a very, very, very long time. So that makes predicting soybean oil prices very difficult. If we switch to fat and grease price projections, what we talked about a couple of weeks ago was this idea that given the demand for fats and greases from the renewable fuels industry and the restricted supply of fats and greases, that we may be at a point where where soybean oil prices might come down, but because we're essentially using up all of the fats and greases that we have, fat and grease prices don't respond in the same way that they have historically. Last week, it kind of looked like fat and grease prices were starting to come down. The other thing that makes it a little more difficult is there's typically a lag between a move in soybean oil prices and the corresponding move in fat and grease prices. So soybean oil prices had already come down a lot, been waiting for the move in fat and grease prices. Last week, it looked like fat and grease prices had started to move lower. And so I adjusted the forecast pretty significantly lower based on the idea that we're going into a recession. Prices have finally started to fall. We're not really at this level where we're using up all of the fats and greases. And so there's probably some room for prices to move down. That decline didn't last that long, or in some cases was not nearly as large as the move in soybean oil would imply. And so this week, unfortunately, my forecasts have had to sort of turn around and come back up. Again, it's something that I think I'm comfortable with now, and I think maybe that we've answered this question about whether we're at the edge of the supply of fats and greases relative to usage. But that could all change next week if fat and grease prices fall off a cliff. It doesn't seem like that's going to happen. And so I think that the forecasts are probably going to change minimally going forward. But the other thing that we rely on, we've talked a little bit about this, is the idea that not only is there a relationship between the fat and grease prices and the soybean oil price, but there's also a relationship within the fat and grease prices. And if you look at what some of the fat and grease prices have done and some of those relationships have started to move in ways that they haven't moved historically. And so again, that adds another layer of complexity to trying to forecast these prices. In particular, DCO did follow soybean oil sharply lower. And so that made anything that we look at in relationship to DCO, those spreads looked awfully strange. Now, it seems like 2 weeks later that move is probably just confined to DCO. Like I said, you've seen some of the fat and grease prices come off a little bit, but none nearly as much as DCO. But as a result of that, you get a situation where in some cases, the price of DCO relative to something else, DCO may have been premium to something else for a lot of history or most of history. And now it's not. The other commodity is a premium to DCO. And so I'm kind of trying to feel my way through this and trying to figure out where I think these new relationships are. Like I said, it seems like DCO is the one commodity that has been most affected by the soybean oil move lower, and that the other commodities have been much less impacted. And so again, I think I've got it straightened out, but it may be that over the next couple of weeks, there are some adjustments that are, again, probably larger than I typically would like to make. Okay, so that's prices, and that's why you saw some relatively, or if you haven't seen them yet, you will see some relatively large adjustments in particularly the fat and grease price forecasts. Beyond that, what's going on? So from a weather perspective, we have a period over the next couple of weeks where the weather looks like it's going to be really, really hot and drier than normal. Not a drought, but there will be some rain, but it looks like it's going to be drier than normal. That's a big risk for the markets because soybean stocks are already tight, canola stocks are already tight. And so any shortfall in production, and we had lower acreage than we were expecting. And so any shortfall in production is probably going to support prices relative to where they would go if we just had a normal growing season. It's still a little early to say that this period of dry weather is going to adversely impact soybean yields. And in fact, one of the things that I say a lot to a lot of people is a good way to get really big soybean yields is to stress the crop early in the year and then pour a bunch of water on it when it's filling pods. And there are two reasons for that. The first is when you stress the crop early in the year, the crop tends to send its roots down deeper to try and find moisture than it would if it just sort of rained once a week throughout the summer. This year we had a lot of rain in the spring, and so I think that impact is probably going to be relatively minor. Subsoil moisture is in a lot of areas is still probably good enough that the crop isn't really going to send roots really, really deep to try and find water. But the other part of it is that if you stress the crop early, what that tells the crop essentially is that it doesn't need to focus on building a big, beautiful 6-foot tall soybean plant. What it really needs to focus on is passing its genetic material along, which is all seeds are, right? They're just carriers of genetic material. And so you see this in a lot of plants. I used to cover FCOJ, and if you had a dry year, you could always predict that orange yields would be much higher than normal the following year for the exact same reason, that the plant was trying to pass on its genetic material. And so it focuses more of the energy that it has on supporting the seeds rather than building big leaves and all of that structure. So if you have a period of dry weather in sort of July, mid-July, and then it starts to rain in August, mid-August, and late September, you can have a crop that doesn't look that great from the road, but you'll have pods full of beans that are really, really big and yield really, really well. And so while the weather is certainly of something that we have to pay really close attention to right now to make sure, well, to see whether this period of dryness is going to extend throughout the summer or it's just a temporary change in the weather pattern that will correct itself later in the year. And it's probably a little too early to tell whether that's true or not yet. I think there are times that you can tell. This doesn't seem to be one of those times. It is still something that that the market will pay attention to. Now, again, given the fact that we're going through this speculative liquidation, even if we do have a shortfall in the crop, it doesn't mean that we necessarily are going to go back to record levels and soybeans are going to go up to $20 and soybean oil is going to go back to $1. But it does mean that the downside risk may be limited if the dryness persists. Beyond that, last week, CARB also held a meeting and talked about the LCFS program and potential changes to improve the LCFS program. And part of that discussion focused on the use of vegetable oils as feedstocks for biofuels. And one of the topics in the presentation talked about potentially adopting rules that are similar to the European biofuel regulations, which limit the amount of vegetable oil that is used as a feedstock. I think that it would be tough. I think one, just broadly, that would support LCFS credit prices. And when we go through the LCFS credit price forecast, hopefully you'll see that we've kind of shifted from going lower and lower and lower to kind of putting in a floor and then sort of slowly raising LCFS credit prices, because I think the discussion itself will probably limit the downside in LCFS credit prices. If they start to actually implement the changes, I think LCFS credit prices would have a lot of upside potentially, depending on exactly the changes that they made. If they do this idea of sort of limiting the volume of biofuel that's made from vegetable oil, it doesn't necessarily impact the broader demand for vegetable oil, because while it may mean that less soybean oil based or SME goes into the California market, we still have to meet the RFS mandates. And since we only have so much fat and grease supply, that means that the percent of biofuel production that goes to California will probably reduce its vegetable oil content or feedstock use, and the volume that doesn't go to California will probably increase and perhaps dramatically the percentage of biofuels that are made from vegetable oils, because it's it's impossible to solve the problem of how do we make this much biofuel without using vegetable oils. One of the other things that I think that they're considering is potentially changing the CI scores for vegetable oils, and the way that they would do that is through the inclusion of land use as a factor in the CI scores. I think they do that already, but from the presentation, I was on vacation, so I haven't had a chance to listen to the whole presentation. But I've gone through the slides, and from the presentation, it looks like if they do include it already, it would be a more strict interpretation of land use, and if they don't include it, that they would start to include it in the CI score consideration. If they go the CI score route, I think that the impact would be a little bit different. I think that you probably would still reduce the amount of vegetable oil used to make biofuel for the California market, because it would reduce the profitability of vegetable oil based biofuel in that market. However, I don't think it would be as dramatic as if they just place a limit on the amount of biofuel that can be made from vegetable oil in that market, because I think that and currently our margin estimates suggest that even using soybean oil, the margins for biodiesel and renewable diesel, well, in biodiesel's case, especially if you use soybean oil, is wildly profitable, probably more profitable than it's ever been. And so you could have a situation where it just drives, because you're limiting effectively the feedstock that's available to that market, it drives profitability in that market substantially higher. The LCFS prices go back up to 200, and that offsets the change in CI scores. Of course, there is a CI score theoretically that would just eliminate vegetable oils from the California market. I've got to believe that one, the next step in the process is public comment. So I'm sure CARB will get a lot of different opinions on the best way to go forward. And some of those opinions will say like, hey, you can't do this without vegetable oils. But two, I've got to think that that they would think about this enough to understand that raising the CI score to a level that eliminated vegetable oils as a feedstock option would not necessarily meet their broader goals of carbon reduction. And so while I could see a change in the CI score that tried to reduce the amount of vegetable oil or tried to reduce the profitability of vegetable oil, I don't believe that they would raise the CI scores enough to completely eliminate that. Now, I'm not, I'm obviously not involved in setting policy in California, and so my opinion is just my opinion. But to me, it seems like making a significant change that really altered the dynamics of the feedstock market in California specifically and across the US more broadly is something that would probably hurt the larger goal of reducing carbon, even as it may help in some other areas like the food versus fuel debate and maybe just the optics of the LCFS program. Okay, outside of that, there was other statistics that came out. There was Canadian plantings and that kind of stuff, and I've covered most of that in the commentary. So let's try and see if this stuff updated. Fingers crossed. It kind of looks like it did, although, yeah, that looks like it did. So as you can see, last week, the margin for our estimate of margins for biodiesel production shot up again to 97 cents a gallon. That's based on a 75% soybean oil, 25% yellow grease feedstock mix. While the profitability of renewable diesel increased or moved slightly less. I don't remember whether it was an increase or a decrease. From the chart, it looks like it might have increased a little bit. But that is a 50% tallow, 25% UCO, 25% DCO mix. So again, think of this more in terms of biodiesel represents using vegetable oils as a feedstock and the profitability of that, whether it's biodiesel, renewable diesel, and our renewable diesel estimate represents using fats and greases as a feedstock, whether that's biodiesel or renewable diesel. And we expect that with the new forecast, we broadly expect that biodiesel margins will remain well supported. I think renewable diesel prices in the difference between renewable diesel and biodiesel prices also are playing a little bit of a role in this. Renewable diesel prices have come down a little bit more than biodiesel prices, so that's also contributing to the relative weakness of our renewable diesel estimate. And I think, again, that given the gap between what we expect ethanol production to be and the implied ethanol mandate, and then the other advanced differentiated gap, that biodiesel margins will remain well supported. I think in the short term through the end of this year, that we really need the biodiesel capacity basically to remain about where it is in order to meet the RFS volumes. And next year, it's a little bit more debatable as the capacity for renewable diesel increases, but I think that you probably still have biodiesel margins relatively well supported, maybe not at the same level that you see this year, but you probably still need a fair amount of biodiesel capacity to stick around next year. And so I think that our forecast for biodiesel margins, as you can see here, stays relatively high. That depends in part on energy prices, and the forecast for energy prices is also been something that has been challenging. We still are forecasting energy prices to remain relatively high, but obviously they've also come down a lot. There seems to be a disconnect there again between the futures market and the cash markets, where the futures market has come down a lot more than the decline that we've seen in the cash markets, because of the removal of this speculative excess. And so while we've cut our forecast for energy prices, we haven't cut it by as much as the futures market would likely suggest. Nevertheless, that remains a risk to our outlook, and there's some potential that margins will be lower than we expect because energy prices are lower than we are predicting. All right, our RIN price forecast. We also cut this this week, although we kept the spread between D4 and D6 kind of close to where it's been, even though, as you can see, our near-term forecast for D6 went down a little bit. For D4, not quite so much. So in the near term, the spread widened out a little bit, but as you get out towards December, you can see we're still below $10, and the real reason for the cut in the RIN price forecast is just the reduction in feedstock costs. Really, if corn prices are going to come down along with soybean prices, the D6 RIN is probably going to come down even with the shortfall. But that gap between the two is probably going to remain relatively narrow by the end of the year, and that's probably going to help support prices, even if they are lower than we were anticipating. And then next year, or early in next year, we've got D4 going up a bit, which is a little puzzling. I think that probably should be down, but I think that's more a function of what we saw this year was that the gap narrowed and then it widened in the first quarter, was relatively wide in the first quarter, and then kind of narrowed through the year. I think one of the questions for next year will be, given that we are expecting another gap between ethanol production and the ethanol mandate, whether that spread will in fact widen out in the first quarter. Typically, we would kind of expect it to, because obligated parties aren't as worried about meeting their RVOs early in the year as they are late in the year, and so that spread tends to widen a little bit in earlier in the year, but we'll see what happens. Either way, I think the bottom line here is that the forecast for record RIN prices, at least at the moment, is probably finished, and I would say that there's probably more downside risk in our RIN price forecast than there is upside price risk. All of that said, if the weather continues to remain hot and dry, then we probably will end up increasing our RIN forecast as we raise our feedstock forecast once it becomes clearer that the dryness is actually going to have an impact on soybean yields and soybean oil production. And then finally, our LCFS credit price forecast. Like I said, kind of have gone from continuing to go down and then maybe starting to go up to kind of flat to slowly higher. As we get more news out of CARB, I think that will shape this forecast a little bit. And I think for the first time in quite a while, there probably is a little bit more upside price risk to the LCFS credit price forecast than there is downside price risk. Now, if CARB goes through the public comment period and comes back and says, oh, we think that the LCFS program is fine, which I think is probably the lowest probability outcome, then I think we would switch back to lowering our LCFS credit price forecast. But assuming that CARB is going to make some changes, which I think we're doing, and I think probably a lot of the market is going to do as well, means that that the chances are better that next week the credit price forecast will be a little bit higher than it is this week, and potentially the week after that, so on and so forth. Okay, so I've got some questions. Can you remind me what's driving the significant increase in domestic SPO use that you have for 22-23? So let me just go back to that and pull that up really quickly so we can all look at the same stuff. Okay, so for 22-23, we really have a much larger forecast for biofuel feedstock demand for soybean oil than we do in 21-22. So more than 4 billion gallons of increase, and that offsets decreases in non-biofuel and exports. We've talked about this in the past. Ultimately, the real number probably comes in somewhere between USDA's 12 billion pound forecast and our almost 17 billion pound forecast. But based on the way that we forecast feedstock demand, it's very hard for me to adjust our forecast just based on the fact that I think that it probably will be lower than the numbers that we end up with. So the way that we forecast feedstock demand is we start with the mandates, and then that drives a forecast for all of the categories under the EPA's EMTS program. So we forecast all of the categories under D4 and D5 and D3 through D7. And then we take that monthly production, and we have two different ways that we do it for biodiesel and renewable diesel. For biodiesel, basically what we do is we try to mimic what the old EIA report used to be, and we adjust the new biofuel production series to try and match up with the EIA data, and then use that series to predict monthly feedstock demand across all feedstocks and try to fit those so that they make sense from a percentage standpoint. So soybean oil obviously is the biggest contributor, and then it goes to DCO and canola and on and on. And what we do is we look at where we are currently. So what has soybean oil been doing in terms of percentage of overall of the overall feedstock demand, or our estimate of what soybean oil has contributed to the overall feedstock usage. And we also look at the pounds of soybean oil that are used per gallon of production, and then adjust total feedstock demand by the implied yield across all feedstocks. So that gets us our biodiesel demand. For renewable diesel, we have a list of all of the plants, and we have assumed feedstock mixes for each of the plants. And we go through and we take our forecast for monthly renewable diesel production, and we basically multiply that by the implied demand from each of the plants, adjusted by if the plant's not open, then the demand is adjusted by a probability that we think the plant will open, but that's kind of minor. At some point when we do that, we run out of fats and greases because all of the renewable diesel plants want to use as much fat and greases as they can. And so most have announced with, or quite a few have announced with a feedstock mix that is some combination of fats and greases. But when we run out of fats and greases in our monthly balance sheet, then we start to add soybean oil, or in some cases for some of the West Coast plants, canola oil back in to make up the difference. And when we do all of that, it all combines to give us these numbers. Now, again, these numbers seem high, and there are ways that this number can be lower if renewable diesel or biodiesel imports are stronger than we expect and domestic production is lower. That obviously reduces domestic feedstock demand. And if the numbers that the EIA reports are just different than we think they should be. Not that we ever have big disagreements with the EIA numbers, but there are times when if you look at what the EIA reports in terms of feedstock use versus what the EPA reports for domestic biofuel production, the yields can get a little wonky. That really drives the renewable diesel feedstock forecast. And it's the renewable diesel portion of the forecast that tends to drive the outsized growth year over year in our projections. Again, a lot of that depends on, one, whether all of the renewable diesel plants will open, and we try and adjust that with the probabilities that we use on whether plants will open or not. And then two, whether production will meet our forecast. On the production side, we're relatively close. The errors are generally not terrible. On the feedstock side, it does seem like our system tends to overestimate feedstock demand or overpredict feedstock demand. So again, that's what's driving the big increase in domestic use. But it will not surprise me if that comes down. If that comes down, what it does is it offsets this 4 billion pound forecast for imports, which again, I'm not entirely, I wouldn't bet my life that we're going to import 4 billion pounds. In fact, I would probably bet my life that we're not going to import 4 billion pounds of soybean oil in 22-23. But given our feedstock demand forecast and the other forecasts, that's kind of the number that we have to use to make the balance sheet work, so that we're not showing negative ending stocks, which is just something that's not physically possible. Oh, and then, sorry, he wrote back and said he understood. So that was a long explanation for people that may not have known that, hopefully. What are your current thoughts on the spread between soybean oil and palm oil and where that may go? And I write about that in the commentary this week, but we'll also talk about it. So the recent move in palm oil, which if you don't pay close attention to the palm oil market, it has just cratered and traded below 4,000 ringgit last week before bargain hunting drove it back up to about 4,200. It traded down to like 3,750, and that's from a high of like 7,000 ringgit not that long ago, within the last couple of months for sure, and maybe within sort of the last 6 weeks. I don't have the chart right in front of me. That's driven the spread between palm oil and soybean oil out to the low 20-cent range, which is not, it's not surprising that that spread has widened because of the demand, the domestic demand for soybean oil in the US, and the fact that palm oil relies very heavily on export demand to drive prices. And so with the COVID, the zero COVID policy in China, shutdowns that you've seen there, and concerns about a broad worldwide economic slowdown, it's not surprising that that spread has widened. What has been surprising is how wide that it has gotten. Earlier in the year, I thought that that we would probably see the spread go out to 10 cents, maybe 15 cents at the top end, but I didn't think that we would challenge sort of last summer's highs, which were around 30 cents. I still don't think that we're going to challenged last summer's highs around 30 cents, although I'm much less sure about that opinion today than I was 6 weeks ago. And we are predicting that the spread probably stays in this low 20-cent range. It seems like right now the palm oil market is really driving the world vegetable oil prices. So typically, I think it's sort of the other way around, that you get soybean oil is the main driver of the world vegetable oil prices, if for no other reason than generally soybean oil futures are more liquid than other futures markets, and so they tend to set the price, and the spread between soybean oil and palm oil historically has been a 4 or 5 cent premium for soybean oil. In this case, I think that, again, concerns about the slowdown in China and relatively weak export demand from India combined with the speculative liquidation have sent palm oil prices plummeting. Now, there is the fundamentals in palm oil also suggest that maybe palm oil ending stocks for the 21-22 marketing year will be above the 2 million ton level, which is kind of the level that I think of as, if they're above 2 million tons, generally pressures palm oil prices. If they're below 2 million tons, palm oil prices generally tend to rise. Right now, we're forecasting 1.78 million pounds, but in this week's commentary, I talk about why and how we might raise our ending stocks forecast above that 2 million ton level in the coming months. And what it boils down to is that if you look at the cargo surveyor data for June and the first 10 days of July, it showed that exports were substantially below where we were expecting them to be. So we lowered our forecast for June and July, but left our marketing year forecast unchanged. That means that in August and September, basically Malaysia is going to need to export 1.65 million tons of palm oil per month to meet our current forecast. I haven't cut the marketing year forecast, in part because last week China announced a stimulus program to try and help their economy recover. If the Chinese economy comes out of the COVID zero slowdown that it's in right now more quickly than anticipated, that could help exports in the last couple months of the marketing year. And just because if you are an end user, if you're an importing country for vegetable oils, right now, this huge decline in prices suggests to me that I'm probably going to start to try to restock vegetable oils, because the world has been short of vegetable oils over the last couple of years. And given what's going on in the world with the war in Ukraine likely to continue on, it seems like, and the ramp up in demand from the US biofuel industry, it seems like as soon as the Fed stops raising rates and we come out of this recession, however long it lasts, that vegetable oil prices probably will start to climb again. Like, I don't think that they will go back to the highs, but this downturn is offering an opportunity for importing countries to really restock at prices that they may not see again for quite a while. And so I'm kind of expecting almost that that end users will take advantage of these low prices, and so exports could be that high in August and September. Those levels are high relative to what we've seen over the last several months and for a lot of this year, but they're not really that high relative to history, and especially not during a period when prices have come off as much as they have. Um, so if that's the case, then it becomes difficult to raise the ending stocks above the 2 million ton level, and the spreads probably starts to narrow in again, maybe back down to probably 15 cents or 10 cents in the extreme. But right now we are projecting it remains close to this range or in this range kind of out for the next year until we know a little bit more about what the Chinese economy looks like, and again how quickly they sort of recover, and whether the big importing countries China and India take advantage of the low prices to restock. Um, on the other side, I think that if you have if the dry weather in the US continues and we really do have a problem with the soybean crop, then you probably could see the spread take out last year's highs and move above the 30-cent level. But at this point, that seems less likely than the spread either staying at this level or kind of moving a little bit lower, because so far it seems like the 20-cent level or around the 20-cent level, you get soybean oil following palm oil. So if palm oil continues to go down, soybean oil tends to follow it a little bit more. What is the public comment period for the LCFS? When will we have an idea on where they are going with virgin oil? I don't know, but send me an email and I will dig into that and follow up with you. Like I said, I just kind of, I've since I'm just getting back from vacation, I just kind of have glanced through the presentation. I haven't really dug into it, but if you send me an email, I'll reach out and try and get an answer for you. I would assume that it's the typical sort of 30, 60, 90 days, but I don't know which one. And then I don't know sort of exactly what happens after that. If it's just the public comment period and then they're going to start to implement some changes, or if it's a public comment period with an eye to make some changes at a date that's already set in the future. But please send me an email and I will I'll do a little digging and I will follow up. Can a 15 to 20 cent spread exist between palm oil and tallow? That is a good question, and that is not one of the spreads that we historically look at. It probably is one that we should look at, though, because tallow and palm oil are two things that we import from roughly the same part of the world. But offhand, honestly, I don't know what the average spread is between palm oil and tallow. If you send me an email, again, I will do a little bit of digging into this, and I can tell you what I think after I've had a chance to look at the data. Offhand, what I would say is that whatever the historical range of the spread between palm oil and tallow has been, that we probably are going to test the upper limit, or the tallow premium upper limit to that range, for the same reasons that we have the big spread between soybean oil and palm oil right now, because the demand for tallow is really, really strong in the US, and the demand for palm oil globally is not as strong. And so I would suggest that whatever that historical range is, you're probably heading into a period where tallow has a premium, or at the very least narrows the deficit to a level that is well beyond the upper end of those historical ranges. All right, I think that is all the questions. Like I said, I am working on the commentary. I've got just a couple of articles left to write. Some of the stuff will be a little bit redundant given that the WASI report has already come out. But so bear with me on that. And I will see you all hopefully next week. Have a great week, everybody, and thanks for attending. See ya.